After the coronavirus meltdown of 2020, he or she said, I'm so proud of myself. When that virus hit back in 2020, I didn't just flip on the tube and veg out on reruns. I got off my duff, created an inspiring life plan, got moving, and took action. I launched a new, breathtaking, more exhilarating life during that pandemic, and I haven't slowed down since. Look where I'm at today. I might never be here if it hadn't been for that virus, and if I hadn't jumped on that window of opportunity with a vengeance. And that is you, listeners. Hi, welcome everyone. I'm Paul Moore.
And I'm Josh Thomas. How to Lose Money is a podcast where we discuss defining moments of success through distinctive stories of failure with business owners, investors, and entrepreneurs.
Today, our guest is Ryan Haley, who's going to tell us how to lose money by speculating in real estate. Hey, Ryan.
Hey, Paul. It's great to be on the show.
It's great to have you, and I want to give credit where that credit is due. That is a quote from Mike Dembski. He's a Bigger Pockets friend of mine, and he got that from his strategic coach, Rick Howcheck, and I've been using that line, and I actually just inserted it into a blog post in Bigger Pockets that's coming out. But I'm really excited because, this is a terrible time in world history. I mean, this is going to go down in the history books big time as one of the worst events, at least of this, for the memory, it's since 1918 at least, in 100 years or so. And I think it's also going to be a time when careers are launched, fortunes are made, and though we're very, very, very sad for all the havoc this has caused and all the death and everything else, at the same time, it is an opportunity for us to take stock, reevaluate. It's a time for invention, innovation, and a time for us to look forward. What do you think, Josh?
Well, I 100% agree with that. And we've had this question, Ryan, I want to get your thoughts on this too. But, having gone through the 2008 economic crash myself and not being ready for it, I was pretty much decimated. But knowing pretty much what's going to happen, I'm looking at this a different way, and I'm preparing for it because there's going to be a ton of opportunity, if not now, in the next few months or years. And those who are prepared for it or are preparing for it right now are ultimately going to be the ones who win. Right, Ryan, what do you think?
I could not agree more. And I've seen this on both sides, both in the last crash, which we'll probably talk about how I learned how to lose money in real estate and investing. And then also the flip side of that in the most recent crisis that we've had. So I could not agree with you guys more.
So give us a little taste about what you're going to share with us in this story today.
So basically, we're going to start off with how I lost a ton of money by not knowing the difference between speculating versus investing, specifically in real estate, back in 2006, before the great financial crisis, and then link that to how I've learned from that. And most recently, just within the last couple of months, kind of done the mirror opposite of that and setting myself up for success this time around and seeing the opportunity in the midst of the crisis.
Excellent. Looking forward to diving into that. Paul, tell us a little bit about our guest today.
My friend Ryan Haley is a former U.S. Navy officer. Thanks for serving our country. An SH-60B helicopter pilot, Afghanistan combat veteran, and a Pentagon defense budget analyst. He's the founder of A Better Way, a media and teaching platform that inspires people to experience where the supernatural meets the practical in faith, business, and life. A Better Way currently includes a podcast, blog, website, and book. Ryan got his MBA in financial management from the Naval Postgraduate School, a postgraduate business administration certificate from Georgetown, and his BA in psychology from the University of San Diego. He's not been busy at all, I don't think, Josh. Ryan is an adjunct professor at Charis Bible College Business School and an active real estate investor. He's originally from Portland, Oregon, now lives in Woodland Park, Colorado, where he enjoys the beauty of the mountains and outdoors through hiking, snowboarding, and playing disc golf. Ryan also enjoys being part of his church and small group fellowships. So we've been saying here, at Wellings Capital that social distancing is only physical distancing. What are you doing, Ryan, right now? I mean, you're a person who loves people. You teach, you hang out with friends, you do all these activities. What are you doing to keep your relationships going during this crazy, unprecedented time?
Yeah, well, it's kind of funny because for me personally, my life rhythm hasn't changed a whole lot, being that I work from home and self-employed, but it has been a wake-up call in trying to get more connected with people. I've been making it a point to hang out with my roommates around the house, which we have a lot of time to do. Just went disc golfing yesterday with my roommate, and just connecting with people, through any means possible. Facebook, the podcast, the emails, phone calls, Zoom, just really trying to be proactive and use the time productively right now by connecting with people and sharing what I have that can benefit others.
That's awesome. My attorney does a happy hour every evening at 6 p.m. Pacific. That's where she's located. And her and some clients and friends just hang out and chat. They're talking about the books they're reading, what's going on in real estate, what's going on, in the world in general, QAnon, whatever they're talking, they're talking about anything. So pretty fun, interesting way to take advantage of this crazy time. But anyway, Josh.
Let's dig into the story here. What is the green flag? Let's take us to the beginning here. What got you going into this situation to begin with? So start us off. What year is it? Where are you at? What are you doing?
So that would start for me in January of 2006. I had just gotten my pilot's wings as a naval aviator in Florida, and I was moving out for my new set of orders in San Diego, California. And I had been talking to a friend of mine in flight school who was looking at buying his home when he got his next set of orders. And of course, at the time, it just seemed like property was going to go up and up and up forever. So now that I have a decent paycheck as a naval officer, I moved to San Diego, immediately get in the game as a smart young 25-year-old young man and buy a $317,000 condo conversion that was one bed, one bath, 729 square feet, thinking that that was a great investment. And not only did I want to live there, but of course it was just going to go up, 10% per year indefinitely. And if I wanted to sell it when I got my next set of orders in about 3 years, I'd be, $75,000 better off. So I got approved for the loan and closed on the deal in March of 2006.
Okay, so a $300,000 one bedroom. What was it? A townhouse? I'm sorry.
Yeah, it was a condo conversion. So it was,
Condo conversion.
it was condos, one bed, one bath, 729 square feet for $317,000.
Awesome. And why?
So again, I wanted a place to live. That was a place I wanted to live. That was about the maximum I'd qualify for on my loan. And coming to the central theme of not understanding the difference between speculating versus investing, it was just assumed that anything you bought in that, especially in that area, Southern California, it was a guarantee in most people's minds that you were going to make a ton of money through appreciation by holding on to it. And that had been true for the last 5 or 10 years before that. We had seen some incredible gains. And so it was just, no price was too much. If you bought land, you were going to make money, and it was just a matter of how much you wanted to hold on for how much you could make. And that was the mentality I had going into that.
Did you
Okay.
at all think, or did you look at the cyclical nature of the sand states? I'm specifically thinking about Florida, California, Nevada, and Arizona, which often double or triple in good times and obviously drop to a half or even a third in bad times. And I'm talking the most edgy investments. I mean, like the resort properties in Florida is more my neck of the woods. Did you think about that or look at that at the time? Because it's so easy not to, especially when you're young.
Yeah, that was one of the things I was actually going to talk about, Paul, is not having an awareness of market cycles. And again, I had just graduated flight school. I was in my mid 20s, And so I wanted to get in the game and do the smart thing, which again, up until that point, that was conventional wisdom. But I had no clue. Now I can talk later about how I assess things and how I was able to do kind of mirror opposite in this most recent transaction. But no, I had no clue about market cycles, where we were. In fact, they even said we were in a quote unquote buyer's market when I bought in March of 2006. And, maybe because it had gone down a smidgen since the year before, but
They say.
yeah, they said. So
They
no, that
said.
is, it's funny, Paul, you mentioned it, because I even looked at one of the things I was considering at the time was a more rundown in the same general area, but not nearly as nice. It was $260,000. It was a 3-bedroom, 3-bedroom, 2-bath, I think 2,000 plus square foot condo that in retrospect would have been much, much better. But again, I had no clue, because I was just thinking of, number one, where do I want to live? And number two, if you buy real estate, you can't lose. It's just going to go up forever.
Forever.
And of course, we found out that was not the case.
It's not?
No, as I found out in a very painfully obvious way.
First red flag, what happened?
So first red flag for me was listening to the radio when I was driving my car, or I think this was late 2007, and people were talking about, this possible financial crisis that was coming, but it didn't seem real to me at all. And then I actually got, before that really hit in its fullness, I ended up getting orders to another location in Northern California. And so I ended up renting out my condo that I had been living in San Diego. And it actually kind of benefited me at first, because this market was changing and tightening. There was a huge demand for 1-bedroom units. And I was actually getting $1,800 a month for the first 6 months or so through a corporate client. And I think it was a traveling nurse. And so I actually saw initially a spike in rent that was about 50% more than usual. But then about 6 to 12 months later, when everything really hit the fan in late 2008, the corporate client that was my tenant basically couldn't sustain his business, and they weren't able to continue to lease out the property. And then things went down to about $1,250 per month, which was pretty normal for that market. But the problem was I had this $2,400 per month total nut between principal, interest, taxes, and insurance. So even when I was doing really great at $1,800 a month, I was still losing $600 a month. And then that went down to about $1,200 a month when things corrected later in the cycle.
Okay. So, you started hearing some news that things are going bad, but that either it's not true or there's no way that it's going to affect me.
Right. Exactly. Because nobody had ever seen anything like this before. And it just seemed, out there. It wasn't kind of like coronavirus was about 3 or 4 months ago for most of us in the US.
Understandable. Yeah. And it's amazing to me. I mean, I had the same kind of reaction to this, like, well, we've been through the bird flu and the swine flu and all this stuff. And that was just invisible to me, at the time. Like, I don't know of anybody that ever affected. I didn't know too many people in the countries where it was rampant. And so, okay, it's just another one of those things. But apparently not.
No.
And there was a certain threshold that was crossed, and it's probably different for everybody, but somewhere around kind of early to mid-March, it was like, oh crap, this is real.
Yeah.
And by then it was way too late, to react, so there's lots of reasons for that, and we can go and explore it in a minute. But I think a lot of it is when, our news media kind of overhypes every little thing to get ratings. It's kind of like the little boy who cried wolf, like, oh my God, SARS, oh, avian flu, swine flu, whatever. Okay, yeah. We're not listening to you guys anymore. And then when something real comes in and it really affects you, we're not ready because we're not paying attention.
Absolutely. Yeah, that was definitely the case for me. And when it really got real for me was when I lost the one tenant, because I think their business pretty much collapsed. So now I've got over $1,000 per month negative cash flow. At the same time, I was living in a very expensive place in Monterey, California, where I was going to grad school for my MBA at the time. Then I lost a roommate and I was paying really expensive rent. And because I didn't understand the necessity of cash reserves, both for my personal life as well as for a property, I was really getting down to the felt there, where it was kind of a question mark whether or not I was going to be able to pay my rent the next month. And luckily I was able to get through it. But that was a pretty sobering and formative experience for me.
Yeah, understandable. Would you say that's your black flag, kind of the point of no return?
Well, I mean, there wasn't really much I could do at the time. But yeah, I would say that was the low point for me financially. And as far as, how bad things got for me personally, luckily I didn't suffer nearly as much as the average person because I had a nice steady government paycheck. I was still making good money and eventually got another tenant in, got another roommate. So things got better, but, it wasn't. And the other thing that I was looking at that time was trying to refinance, with, my loan. And of course, nobody would touch me because now it was not only an investment property since I wasn't a principal resident, but it was also, completely underwater. The loan to value ratio was probably, 100% or greater. So I understood I was really stuck. I didn't really have any choice in this matter. And I just had to kind of get it out.
What was the, looking at the white flag here and, kind of assessing the damage, you know, this was obviously a big speculation and a really big bet for an inexperienced investor. What was the ultimate cost to you on this?
Well, luckily for me, the ultimate cost was not nearly as bad as it could have been. I ended up selling the property in 2012, 6 years after I bought it, at a 50% loss to some cash investors. But because I was in the military and I fit certain criteria, I was eligible for what they called the homeowner assistance program. So basically, the military covered the $135,000 loss between the purchase price and the sales price and what was left on the mortgage. But so I was really lucky to get out of that. But at the same time, it was a bitter pill to swallow because I had paid $2,400 a month for 6 years and had zero equity to show for it. So, what would have been the easier, more fun option at the time, just rent a place with my buddies at the beach and pay $800 a month for a really nice place that was better located than what I had. I, thought I was going to be building wealth and doing the smart thing. And that turned out not to be the case because of a once in a generation occurrence. So, I mean, ultimately for me, it was basically just paying exorbitantly high rent essentially for those 6 years and having nothing to show for it. But I got off a lot better than most other people did. So for that, I'm grateful.
Okay. Yeah. 50% loss on that property.
Yep. So I ended up selling it
for
for 165 in 2012 after buying it for 317 in 2006.
So you had some government kind of subsidies that came in and saved you a little bit, but still
Quite a
it's
bit.
big
Yeah.
loss.
Yeah, exactly.
Wow. Uh, Paul, I know that there are lots of lessons to learn from this, and so I think it's appropriate to do our failing forward. But I think it's also, Ryan has learned so many lessons from this experience and applied them successfully to what's happened in 2020. So maybe you can kind of walk us through that.
Yeah, I would love to, just kind of whiz through these failing forward questions as we always do, but then talk about, lessons learned and where do we go from here? Because almost every investor I'm talking to is asking, what now? What next? Where do we go from here? And I think I've got some ideas, and I think Ryan does too. One of the things I love about what you're saying, Ryan, is the importance of learning to not speculate, I should say, versus invest. Investing is when your principal is safe and you generally have a chance to make a return. Speculating is when your principal is not at all safe and you've got a chance to make a return. And speculating, sometimes something that looks like a safe investment can be really speculative, especially in those sand states like we talked about earlier. But I think that's where a lot of wealth is actually generated. And so our fund, Wellings Capital Funds, invest. We don't focus on the sand states or not, but the point is we are investing in assets that have a very safe principle, and then we make it safer by actually creating a margin of safety. And the way to create that margin of safety is to look for deficiencies in the asset, in the way it's being run when acquired from typically a mom and pop, that can be fixed quickly, and then that margin of safety, that buffer, if you can buy at a 4 cap, which nobody really wants to do, but if you can buy there and then you can have it at an 8, running at an 8 cap, in other words, effectively doubling the income in just 6 months. We see this all the time with mom and pop operators, and it's what we do at Wellings Capital. And so we're really, creating that margin of safety is absolutely critical, but I digress. Anyway, so failing forward, I'm going to ask you 5 questions, and you can just answer each one in 1 to 2 sentences. Are you ready, Ryan?
Yes, sir.
All right, number 1, bottom line, why did this failure experience happen to you?
Because I did not understand the difference between speculation and investment, and I was looking at my home primarily as a principal residence, not as a long-term investment.
Excellent. I'm writing a book with some friends on Warren Buffett's principles, and that's one of the big things we're going to be hitting, the difference between investing and speculating. And he learned that from his mentor, who he just, he basically just almost worshiped this guy, and that was his, one of his main life messages. So what's the single most important lesson you learned from this?
The value of cash flow.
The value of cash flow. Now, if you had great cash flow and it was in a risky investment in a sand state, do you think do you feel like the cash flow still offsets some of the risk of the change in asset value? In other words, if the asset value drops to half, but you're holding for 25 years anyway, and you're getting good cash flow, do you think that's a lot safer than just speculating on price?
Absolutely.
Yeah.
Because number one, you have the opportunity to hold on. You're not at the whim of market forces. And when as somebody recently told me, you never want to be in a position where you either have to buy or have to sell because of external forces. You have the option to capitalize at a time when it makes sense to do that. So absolutely, the cash flow doesn't necessarily protect the market price at any given time of the asset. But I think in a lot of cases, as we could talk about with this new experience I just had where the opposite happened, sometimes it actually can, especially with income-focused real estate, as you're familiar with, Paul, in the commercial space, and that can make a huge difference.
Right. So what do you do? We'll talk more about this later, but in a sentence or two, what do you do to protect yourself from failing in this way again?
Well, number one, a huge difference that I haven't talked about yet between the first time where I bought in San Diego and this most recent time I just bought a couple years ago in the Midwest is the difference of how much leverage I used. I was leveraged to the hilt the first time. We had what we called back then a 95-5 loan, where I basically had nothing down. And so it was,
Right.
I was hugely leveraged, didn't have much equity to start with. The most recent time, it was actually kind of amazing. It's a whole story in itself, but I was able to purchase this fourplex with all cash. So I had zero debt, which obviously lessened my risk significantly, especially for the hold and the cash flow during that hold period. And it also helped me to be able to hold on, even if the asset price were to change or external forces took effect, which they certainly have now, but we can talk about in a second how I was really lucky to get out of that. But that was a big difference, is the difference between cash flow and debt, and the ability to call the shots and buy or sell at opportune times. So that was a big thing for me. And then also looking at the margin of safety, I was looking at this most recent investment that I purchased as purely an income approach. I was only looking at cash flow. I was expecting zero appreciation. And we can talk in a little bit about how, ironically, most of my returns did come through appreciation, but it was only because I had the cash flow. And there's different reasons for that.
That makes total sense. I can't wait to hear more about that. So who do you turn to when you need help, Ryan Haley?
Well, people like yourself, Paul, that I have a personal relationship with and professional rapport, people that have in-depth knowledge and experience in their respective fields. Obviously, close friends and family are huge for me. And then as a person of faith, I actually, use the Bible and my prayer and time with God to give me some really interesting, sometimes seemingly foolish and crazy decisions that, just like this most recent purchase and sale, actually have miraculously great bottom line results.
Yeah. So last question, Ryan, what advice would you give to someone else who finds themselves in a similar position to where you were right when you were deciding to buy that place in the first place? You were evaluating the deal.
You're talking about the first deal in San Diego that I lost money on?
Definitely.
Number one, understand the difference between speculation versus investment. And the way I would define that is speculation is kind of based on the greater fool theory, as they say, which is that you're buying it assuming that somebody after you is going to pay more than you paid for it. And you also want to make sure you are aware of where we are in the market cycle. When things have been going up and up and up at crazy unsustainable rates forever, there is always going to be a reversion to the mean. And that's a big concept in any kind of investing. And then also understand how much leverage you have and can you hold on? What if you get laid off? What if you have these different things? Do you have a margin of safety, not only in the purchase price and the cash flow in your projections, but also in your personal finances? Do you have a healthy chunk of change set aside that you can weather a storm because you've got the savings that you can ride it out?
Well, we all knew it was coming. I mean, Buffett, Ray Dalio, I think either Ray Dalio or Howard Marks just took a huge bet on a potential recession that would be coming soon. And I heard that they actually let the option expire right before they needed it. I heard it cost them like some incredible number of billions of dollars. If anybody has the facts on that, I just don't have it in front of me. I'm pretty sure it was Ray Dalio
I think
who
you're
wrote
right.
the wonderful book Principles. But we all knew it was coming. Nobody could have predicted that one or two or three people, however many, eating a bat or whatever in China would have caused the entire economy to shut down. But here we are. So what tell us what you did in your other investment in Columbus that was different from this one. I've been hanging out with Ryan online and on calls for about the last 3 months, and I got to hear this unfold. So tell us what happened real briefly. We're running a little bit long on time now.
Sure. So like I mentioned, actually learned the difference between speculation investing and was able to miraculously buy an all cash purchase of a fourplex in Columbus, Ohio, back in October of 2017. And there's a lot of margin of safety with the purchase price compared to the market price, the cash flow that I was projecting and how much I could, weather a storm, and my personal savings, as well as having it be all cash so I didn't have any debt. So um, I was really looking at it again, only assuming I would be holding this for income for my personal life. And I was living off this, because I don't have a full-time regular job. So this was, paying the bills on a monthly basis. So that's a different way that you approach things when it's very real. Every dollar matters a lot more when you're living on it. Then because it had such good cash flow and because the market was, and I was well aware of where we were in the market cycle as well. So as more cash flow focused real estate investors were finding it harder and harder to locate deals in any area, but particularly Columbus, because the secret kind of got out, they were going further afoot to try to find that yield, even to more rundown neighborhoods like mine was. It's a great property and a great location on a really bad street. So people were willing to take more risk to get that higher yield. So because of that, because I had the cash flow and could hold on to it and wasn't affected by any external forces, and because other income focused real estate investors were looking for similar type properties, even though my plan initially was like Buffett to just buy it and hold it forever, it became almost too good to pass up the opportunity to sell. So long story short, I ended up selling it for an all cash deal just last month. And I guess 2 months ago, technically now, February, the very beginning of February, I sold it for 40% more than I bought it for back in 2017. So my overall return on that, including, the cash flow through the hold, as well as the net sales proceeds, was 43% over a little less than 2.5 years.
Quite impressive. And you bought it fall of 17?
Yep. October 2017 is when I purchased it, and I sold it in February of this year.
Yeah. Wow. So I think you've hammered this point through the whole thing, and that is, again, the difference between speculating and investing. Give us 1, 2, maybe 3 ways this was different.
Well,
than
number one,
Diego, and in a way we can apply to our lives.
like I said, I was looking at it purely based on the net income it could provide me on a monthly basis. I was assuming I would not make any money on appreciation, which is in that market, it's a pretty straight line, slow and steady economy. So you're not getting those same kind of crazy gains. And like I said, it ended up being most of my returns did come from appreciation. But going into it, I assumed I have a large margin of safety on the purchase price versus the sale price. I have a large margin of safety of how much I think it's going to generate in net income per month. But even if it was half of that, I'd still be okay. And I didn't have a debt. The other big difference that I had starting out with this was working with someone who took a top-down approach to markets, because I always just thought if I lived somewhere, that's where I'd invest. And I live in Colorado. The numbers don't make as much sense as far as the price to rent ratio. So that's another thing to look at is the overall market. Columbus is really strong. The price points are good compared to the rents. It's got diversified employment sectors. So it's not a town like Detroit where if one industry goes under, like the auto industry, everybody's out of work. It's got a lot of universities. It's got good population growth and demographics. So taking a top-down approach to the initial market and then looking within that market to different locations and then specific properties that have the characteristics that are going to generate a good profit, but also be really safe for the long term.
Did you know that one of the most famous large real estate losses, I mean, I don't want to say in history, I don't want to sound like I'm exaggerating, but probably in history, in multifamily history, was in Columbus, in the same part of town that you did yours?
Really?
I don't know if you've heard of this.
No, I haven't.
Yeah, we had a gentleman on our podcast about 2 weeks ago, and I don't actually know when it'll be released because I know we're not releasing these in order, so it might come out much later than this one. But he told the story of how he went from 21 or 22 million in net worth to 41 million in net worth to negative 21 million in net worth because there was a horrific, what was it, ice storm that hit Columbus, Ohio. And I think it was 2007, 6, maybe 2004, 5, 6, somewhere in there. And it was right in the same part of town yours is, over near Whitehall in that part of town. And
Wow.
he had a apartment building he had bought for 12 million that was worth like 40 or 50 once he fixed it up. He had it all fixed up, and the ice storm destroyed it, literally destroyed it. And then what he did is he went and refinanced all the other properties he had around the country to try to fix it. And then it was condemned by the city and bulldozed. He lost it. And the insurance company fought him and wouldn't pay
Oh,
most of it.
wow.
It
Wow.
was
That's tragic.
unreal. And
Wow.
so, I mean, that tells me there's nothing completely safe. And I hate to say it this way. I'm an optimistic guy, right, Josh? But I mean, here I am, I mean, even this guy had all the margin of safety built in. He had insurance. There was one clause in the insurance that, that allowed the insurance company to wiggle out of most of it. But because he was trying to be a good guy, he took 20 or 30 million in cash out of other deals to throw at this. And then the city decided it was an eyesore, and they, through some political maneuvering, got it condemned. And he was out, and he had to start over like 20 million in debt coming out of this. And now he's doing great. He's in Chicago. And it was one of the most dramatic stories we've had on how to lose money. And so I'm looking forward to our listeners getting a chance to hear this. But anyway, just as a reminder, I mean, and this whole coronavirus is a reminder that no matter how well we plan, no matter how well we make our plans, something could happen. And nobody could have dreamed this would happen. What are you thinking right now, guys? What are you thinking is going to happen next, and how will it affect investors and people in real estate and other places? What are you guys thinking?
Well, we had a conversation with Neil Bawa, and I believe that episode was released at the end of March.
I believe it was, the end of March, the 30th.
And Neil says that we're looking at about 3 months of suck. and then in Q3 that things are going to kind of open back up. People are going to go back to work, businesses will restart, and the economy will get going again. Now, if you're listening to this and it's like August or September and we're still in the suck, well, we were wrong. But I think that Neil has a really good point by saying, nobody knows what's going to happen at all, or how long it's going to take. There's no time frame or anything like that. I saw a tweet from I think it was Laura Ingraham, who posted, the American public deserves to know a timeline for when this will end. We can't do with all of the uncertainty and those sorts of things. And the response that I saw to it that got the most kind of likes was, Laura Ingraham wants to talk to coronavirus's manager. The truth is, no matter how much you complain, or how indignant you are, or how unaccepting you are of this situation, you are not in control. You're not. The coronavirus is not something that can be managed. It's a virus, and it's going to do whatever it's going to do, and we have really no protection against it. The only thing that we can do is countermeasures: wash hands, social distancing, all of those other sorts of things. Be a healthy person, exercise, stay sane, those sorts of things. But it's going to take however long it takes. One thing that we do know for sure, and Ryan, I want to get your opinion on this. The one thing that we know for sure is the economy is going to come back, and it's going to be wherever it's going to be. It's going to be the same as it was, or it's going to be lower. Maybe it's even higher, unlikely. But the world is going to open back up at some point, and we'll be in business. And there will be deals to be found, just like there were deals to be found before all of this. And so the only real variable is the amount of time that we have to be in the suck. What happens on the other side of that is pure opportunity. And it's pure conjecture, really, at this point. Ryan, what do you think?
Yeah, I absolutely agree. And I'll echo what Paul said at the beginning of this and on a webinar he had that I attended recently, which is that this could potentially open up some of the greatest investing opportunities that we've seen in a decade, or possibly even in a generation, depending on what happens. So I think you're right. We can't control things, but we can live by time-tested principles, have a margin of safety, have enough savings, look well into the matter and understand what's going on. But again, without confusing speculating versus investing, what I'm looking at are fundamentally valued opportunities that make sense based on known historic or present conditions. So again, the cash flow of a property, the earnings of a business, whether it's in the stock market, in real estate, or something else, what you know is that at a certain price point, something that didn't make sense to buy before is going to make sense to buy now. So maybe you were looking at a 4 or 5% cap rate on an apartment building before all this happens. Now, depending on what happens either now or in a couple months, you could be looking at maybe an 8 or 10% cap rate. And if you've done the due diligence and understanding the market, your tenants, and, as much as you can possibly look into without, of course, having complete control, I think understanding the value of investing on what the intrinsic value of the asset is, not just assuming other people are going to pay more, with the understanding additionally that cash flowing investments, especially right now with a high margin of safety, are going to be very attractive to other investors right now and into the future. And I think that's why dividend stocks tend to be stalwarts, because they've got enough fundamental underlying business opportunities and systems that are well managed to keep capital safe during bad times and maybe even pay a higher yield. So I think it's just looking at opportunities, understanding the asset, understanding the situation, and being smart about what your personal situation is if you're in a position to capitalize on that. And I think there will be greater and greater opportunities as things go on.
And if you're not in a position, hold on, Paul, if you're not in a position to capitalize on that, you should get yourself there.
Yes, absolutely. Absolutely. And that was one thing that I noticed for a long time with myself, is I had built up a ton of savings. I had built up, even after I made what seemed to be an impossible all cash purchase for a fourplex, I still had enough savings left over and enough buffer in my monthly income that I was going to be totally fine no matter what. And so if you're not in a place to purchase an asset right now, get yourself there by saving, investing. I know it's hard for a lot of people, but we've got some stimulus coming our way soon. Partnering, exactly. That's hugely helpful. And if nothing else, just starting and educating yourself by listening to podcasts like this and Bigger Pockets and all kinds of other resources to understand, so that when opportunities do present themselves, you understand them and you've been building up the safety and the resources to be able to buy them.
Yeah, this to me, Josh, tell me if I'm wrong. You and I have both been involved
You're wrong.
Well, thank you. We've both been involved heavily in coaching and mentoring. Wouldn't you think that right now would be one of the greatest times to get coaching and mentoring, and more than ever, Josh?
The tell me if I'm wrong. But who did the quote? Was it Warren Buffett?
You're right.
The best time to the best time to buy is when there's blood in the streets, or something like that.
It was actually a quote from Baron Rothschild, or Baron,
Okay.
however you say his name. He said the best time to buy is when there's blood running in the streets, and that is absolutely true. Buffett, of course, and Dalio, Howard Marks. I mean, I'm reading all their stuff saying the same thing.
So here's the thing: you are kind of hoarding your resources right now because you don't know what's going to happen. And that's your survival instinct. That's the bottom rung of Maslow's hierarchy of needs. We're trying to make sure that we can put food on the table. But once you know that you've secured that, you have to understand nobody got to where they are. Anybody who's successful got there from taking some sort of calculated risk. Mm-hmm. Because if you live your life risk-free, you're going to be exactly where you are now in 6 months. And are you going to be happy with that? Are you going to be satisfied with that? If the answer is yes, cool. Just keep doing what you're doing. It's okay for you to be here right now where you are. But are you okay being here in 6 months, in 1 year? And if that answer is no, then the time to change that is not in 6 months. The time to change that is now. Your future self will thank you. And so whether it's coaching or mentoring or, going and making an investment, don't be like Ryan and buy a 1-bedroom condo for $300,000 or whatever. And learn the lessons from people who have been there, but make smart decisions and get yourself out of your comfort zone. Because if you stay in your comfort zone, you're always going to be comfortable, and you're just not going to grow that way.
Agreed. So like I said at the beginning of the show, the hero of the story, we've had a lot of, quotes from famous people who became heroes, but the hero this time, my friends, is you. Because if you, at the end of this, whether it's 6 months or 6 years from now, are able to say, I'm so proud of myself. I didn't just flip on Game of Thrones and veg out on reruns. I got off my butt. I created an inspiring life plan. I got moving. I took action. I launched something new and exciting. Then you are going to be the hero of your own story. And more importantly, I think we're put on this earth to love others. And so you're going to be able to be the hero for others, a lot of others who are not going to necessarily be in a position to take the action that you are. So go for it, my friends. Go for it, Ryan. Go for it, Josh. Listeners, do it. This is the time to do it.
Awesome. Ryan, tell us a little bit about what you're doing now and how people can connect with you and reach out to you.
Yeah, well, it's right on the lines of what you just said. Obviously, I just cashed out my real estate proceeds. So I've got that sitting in my account waiting on an opportune time, not hoarding, but just waiting for, the right opportunities. And then in addition to that, coming back to yes, we're in the middle of a crisis. Yes, this is unprecedented in some ways, and it's really scary and uncertain. But I really think these are where the greatest opportunities lie, both investing, as, Warren Buffett says, be greedy when others are fearful and fearful when others are greedy. But also, I've heard that the vast amount of fortunes that have been created have been done in economic downturns and recessions. And not only with real estate or stock market prices, but also in your own business, your own opportunities. For right now, for me, what I'm about to do, and I didn't time this, but I think it worked out really well, is I'm about to launch my first book that I'm publishing on April 9th. And so I think it's actually a perfect time because people are kind of a captive audience right now that they don't have the ability to go to work. So there's a lot more discretionary time. People are binge watching Netflix. So I'm hoping this book can give them some encouraging perspective and an opportunity to apply the principles in the book, and that they're going to be encouraged by that and also benefited in a practical way. So I'm still doing my podcast. In fact, I had Paul on a couple episodes ago. So I've got a podcast, a blog, and just opened up coaching. You can all get to that and the book through my website, which is abetterwaypodcast.com. And you can stay up to date with everything going on with that.
abetterwaypodcast.com.
Yes, sir.
Excellent. Ryan Haley, thanks so much for joining us. I really appreciate you coming on, sharing this story, and kind of digging into all of the opportunities available to us in this potential economic downturn. So for those of you who are interested in learning more about Ryan, you can go to his website, abetterwaypodcast.com, connect with him there. To our listeners, thank you so much for joining us. We really appreciate you. If this story's had an impact, the best way you can show your appreciation to Paul and I is to tell a friend about how to lose money. You can tell a friend how to lose money. That's really the best way you can show your appreciation. Now, you can access all of our previous episodes on howtolosemoney.com. We're also on iTunes and Spotify. Until next time, remember this: failure is a fact of life. Whether or not it defines you is a personal choice.
Thanks, Ryan. Goodbye, everybody. We'll see you here next time at How to Lose Money.